From the morning reading, stocks stumble on weakness in discretionary and healthcare. EA soars, Disney drops. 2 of 9 sectors moved higher on Wednesday. XLU, XLE, and XLB were the strongest sectors, while XLY was the weakest sector. Oil futures rose $1.46 to close at $45.99. Breadth weakened as decliners led 1935 to 1102 in the New York Stock Exchange and led 1676 to 744 on the NASDAQ. Qs, Spiders, Diamonds, and IWM pulled back after Tuesday's massive rally. All four are still above support and trend is still bullish. And general consumer discretionary and healthcare stocks weighed on the broad market on Tuesday and led many stocks lower. Optimism toward the Treasury market has reached an extreme. The Bond Optimism Index is now in the top 2.5% of all readings since 1991. Despite the long bull market on bonds during that time, when optimism has been this high, bonds have tended to struggle over the next 3 to 6 months. The swings in interest rates are also influencing stock market breadth. This is a common complaint whenever we reference the performance of securities on the New York Stock Exchange, since many of them are influenced by interest rates. But this is not a new argument. Rates have influenced New York Stock Exchange market breadth for decades. Currently, improving breadth may be indicating rising rates. Stocks suffered a reversal on Tuesday's rally. The S&P 500 fund, SPY, closed below Tuesday's low, even after gaining more than 1% on Tuesday. Prior reversals when the fund was above its 200-day average led to further weakness over the next 2 days, 28 out of 40 times, averaging a negative 0.5%. There was no edge after that short-term bout of weakness. The carnage in retail stocks pushed the optimism index on XRT below 5. It has been a while since the market has had an optex below 5, and it typically precedes a short-term relief bounce. The longer-term averages on XRT are not especially extreme, and it's about to enter its most negative part of the year, so the prospects for a longer-term bounce aren't great. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:15 a.m. Central Time, and I'm recording this in preparation for the market day of May the 12th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce over to the morning report, and pretty good action in the overnight. On all 4 U.S. broad market indices, we're up right around 0.5%, or about 12 points on the S&P futures. Crude oil's up almost 1%. Euro is down about 1/3%. Bonds are down about 1/3%, and gold is down about 0.5%. In overseas action, it's mixed. China's right at scratch. Hong Kong's down about 0.75%. Japan is up nearly 0.5%. Germany's up just over 0.5%. And United Kingdom is at scratch. In terms of U.S. macroeconomic reports of some note, we have the weekly unemployment claims, import prices, nat gas storage report, and we have FOMC member Rosengreen speaking, and a 30-year bond auction, followed by FOMC member George speaking. So actually quite a big slate of potential influencers to market action today, so be aware of that. In terms of looking forward to tomorrow, core retail sales, PPI, retail sales, core PPI, all those, that cluster of reports. The University of Michigan consumer sentiment, and that looks to be about it of note in the United States. Current volatility conditions, we have been decreasing in the 5-day versus 10-day comparison. Short-term VIX is at 13.75. Skew is benign. IV percentiles exceedingly low, though they moved up just a notch yesterday. S&P's at 8, Russell's a 9, NASDAQ a 14, and Dow a 12. One of the things, and taking and following the number of standard deviation moves and the degree of those moves, is it gives us a perspective as to where the market's volatility levels are, but also sometimes to a direction. And you look here, while we've had, for example, in the last 10 sessions, 5 standard deviation moves, the preponderance of those moves are to the downside, with 3 standard deviation moves to the downside against 2 standard deviation moves to the upside. And you look across here, you see there's a bit more orange than there is green. So while many of the indicators are saying that we're in a bullish mode still, there certainly seems to be a quite a struggle by the bulls to actually achieve anything, and the bears certainly are picking their moments and pretty much knocking the bulls right back where they came from. It's kind of a 5 steps forward, 4 steps back kind of approach right now. And you see the Russell, 3 negative standard deviation moves to 1 positive, 3 against 2, 3 against 2 on the other 2 markets. So something to kind of keep in perspective. In terms of the charts, let's go ahead and go over here, and we're going to use the S&P futures since we've had a fairly significant overnight action. We'll zero in here to the most recent action that we've been following, and of course up against this significant area of resistance and then a secondary area of resistance right across the tops here, where you have this diagonal resistance trend line in place, and we seem to be having trouble getting through that. So we'll continue to watch, and if you'll, today's action, if we get up about 2075, that'll be of some interest, and then the next interest area will be getting above about 2080 on the S&P futures chart. So 2075 to 2080, about a 5-point range there. Pretty important area of initial resistance for us to fight. We get up through there, then we probably run back up to the 2100 area, and then probably wall off a huge area of resistance up there. So that's the current kind of boundary zones to the upside. If we should fail against this, then we probably are watching to see what happens if we get down here to this 2025 to 2030 area of support. That's also where you're going to start running into the cloud as well, and which also represents support. So that's your kind of play zone for today and the next few days in the S&P futures. The Dow futures are looking very much the same pattern. Not a lot to distinguish there at this time. Nasdaq's been really slogging it out in the cloud down here. A lot of overhead resistance for the Nasdaq to work through. Some of the earnings reports on the Nasdaq have not been very helpful. That certainly is part of what's going on there. And then finally the Russell. And the Russell's got a very similar kind of picture after it broke the diagonal and horizontal support and basically has formed a new level of resistance and is trying to determine whether it can get through that. We could draw the same lines we drew on the S&P futures, looking for a diagonal resistance, then looking for a swing horizontal resistance. If we can get through those 2 lines, which are not that far away, then we probably come back up here and visit these swing highs of around 1154 on the TF or the Russell futures. Let's take a look at bonds and see if it's telling us anything. And it's right smack in that area of resistance that we've talked about. Probe just above the line that we had drawn, but closed below it. And then the overnight action has been, decidedly rejected from that area. So we're back down here, below, at this moment, the area of resistance. So that seems to say that bonds aren't going to go anywhere long at the moment. In terms of gold, gold is just a slop fest. I mean, I still think that this is generally bullish, but it sure does fight its way to make each move. And it seems like you get the big explosive move and then consolidation. And then you get a little bit of a move up and consolidation, a little bit of a move up and then consolidation. I mean, it's really having to fight hard to get its advances. And the advances, generally seem to come in relatively short bursts. This one obviously was a longer burst, but if you're not already positioned and in, you won't be there probably. Many of these bursts happen in the overnight. You won't be there for the actual surge forward. So it's one of those things where you probably need to build a position, perhaps build it over time, scale in, use defined risk, or something along those lines. Pick your moment. When we last entered, we went in right around here as this was coming towards apex, anticipating that we would break out. And sure enough, we got that. Though once we got that, it seems like it's just kind of retraced about half that move and has not done much since. So we're now waiting again to see the next move up, and we'd like to see it, come up and clear this 1306 high on the gold futures chart. That is probably the best play on gold right now. And a quick look at crude, because crude has been in such strong correlation with the broad market indices of late. And right now, crude seems to be wanting to make a move to the upside. And it is right up against its prior swing highs at this point. It certainly has some room to get up here to about $48.50 and then up to around $51. It would be your next two zones of resistance. And we look at volatility. Volatility continues to play near the lower edges. We continue to stalk. We're trying to look for something below a 13. If we can get something below a 13, we would like to put on some VIX or volatility type hedging plays. We keep just playing just above that. So looking for that opportunity to put those on. In terms of what VIX is telling us about general market direction, it would seem to say that things are relatively calm and benign right now. Not a lot of fear premium being priced in. Awful lot of overhead resistance on this. So it doesn't seem to be setting up for any kind of severe increase in volatility, which would mean a market decline. That doesn't seem to be in the cards at this point. Obviously, new information, new action. In terms of the daily report, there's some changes here today. We have intermediate term phase opinion remains at phase 5, which is defined as the end short term, the break of diagonal or horizontal support. In terms of our three market timing signals, the first one from IBD remains as uptrend under pressure. GMI index, the second one, deteriorated some yesterday to a 2 out of 6. It was on the verge of going to a buy signal and then totally nullified by that action and weakness from yesterday. 2 out of 6 on the GMI index. The more sensitive GMI 2 index, a 5 out of 8. In terms of decision point, we did get a new signal yesterday, and it wasn't a good one for the bulls. When you look at the intermediate term, that had been solidly green until yesterday's action, and that broke the back on the NASDAQ with the trend model signal going to neutral. So we now have, when you look at the stack, and the stack of course is reference to the short term, intermediate term, and long term, we'd love to see alignment of the signals across those different time frames and across the different indices, and it's anything but that at this point. Short term decidedly weak, and now the intermediate term has a crack in it, though you still have to give the preponderance of the signals to the bulls, and the long term is totally mixed. So this is just about as messy as it can get. We'll continue to watch to see if this intermediate term signals start to continue to deteriorate. In terms of position sizing opinions, still remaining at 50% for portfolio and 75% for active trader volatility base. Intermediate term market posture. Remember yesterday we talked about how squeamish we were about a first day signal to the bull side. Well, it did manage to survive that weakness yesterday and still retain as a second day a weak bull sign that's actually probably 41.3. But for example, in the Dow, I mean, it literally moved up 1/10 of a point from a 43.1 to a 43.2. It was just about as weak as it could be and still retaining that score. NASDAQ also a weak bull. Russell turned bearish, so that one turned back down. So you could see why technically this signal is weak bull, which would give you permission for novice traders to do short-term to intermediate-term new bullish trades. We're being pretty cautious in the trading room as to our initiation of new bullish swing or other short-term trades. So just kind of keep that in mind. But we do recognize that this has turned into a weak bull signal, and we'll continue to see if this, does get reinforced. In terms of the hedge warning status, level 1 plus, no change there. Caution with an increasing number of warnings firing, and we did have some new warnings fire yesterday. We had market in decline and the sharp increase warning both came into play. The volatility ratio warning is still in that upper reversal zone awaiting a firing signal, and it's been firing repeatedly just to go back into the reversal zone. So this one has been, definitely many signals here in recent trading days. Distribution day count currently at 8 for the NASDAQ, 7 for the S&P. Other things are benign. The 10-day expected move is less than a 40. The skew is benign. So there certainly is some things here that the bulls can point to. New highs, new lows were relatively benign yesterday on both sides. But we are continuing to be troubled by the fact that the key intermarket risk aversion indicators are still all flagged as risk off. Sentiment, bonds and gold are relatively high sentiment. Watch for potential reversal patterns on those two. Fear and greed index came down a few notches yesterday to a 62. So that one is relatively neutral. In terms of sector specific percent change, you see that the short to intermediate term continue to be pretty troublesome, with special note to consumer staples, energy, interesting enough, and utilities being the three sectors that are holding up the most consistent. So, and indeed, utilities was the only one that was positive of all the sectors yesterday. So kind of keep that in mind. We seem to see this kind of rotation back and forth, flip-flopping without a lot of consistency. You remember the day before, utilities was one of the lower areas, and it was all about high beta, risk on during the big up move. A lot of risk on sectors did well. Well, then the very, very next day, you see many of those gains were just wiped out and given right back. So it is a very, very neutral sideways market at this point. No changes in terms of the ETFs that are an intermediate term bullish. A good mix still of both defensive and higher beta, more risk on kind of areas. So no changes to that. In terms of, let's go to our wrap up. And we're just about 20 minutes, so I'm going to go ahead and scroll. If you need any more information on any of these opportunities, just hit the pause button and get the details that you need. Go to the hyperlinks for additional information. On YouTube, we're closing in on 200 subscribers, and while we get literally thousands of views, those that subscribe get notice when content is posted, and we think that would be most helpful. So you might want to consider doing that. Subscriptions are free to the YouTube channel. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And of course, the full set of disclosures can be found at this hyperlink down here at the bottom of the slide. We'll see you back here tomorrow morning with the Falcon Global Market Preview. In the meantime, good trading.